Every country on earth is in debt. It is the defining feature of our modern existence, a burden so colossal that the human mind struggles to comprehend its true scale. The United States now owes over $38 trillion, the highest figure in its history. The European Union carries a debt load of around $14 trillion. Japan, an island nation with an aging population, owes almost $9 trillion. Even oil-rich nations like Saudi Arabia or export powerhouses like Germany and China all owe enormous sums. What if I told you that the wealth of nations is not measured in gold, but in the ability to delay a reckoning? And what happens when the bill finally comes due? We are living on a planet drowning in over $315 trillion of total debt, a figure that is nearly 3 times the size of the entire global economy. To visualize this number, one must think in physical terms. A stack of $100 bills equaling $1 million would be roughly 40 inches tall. A stack equaling $1 billion would reach into the stratosphere. But a stack of $315 trillion, that would reach to the moon and back 50 times. This is not merely a number on a spreadsheet. It is an astronomical anomaly. But here is the paradox that haunts financial historians. If everybody owes money, who exactly is owed? Nothing in finance is ever as simple as it looks. Debt is not just a burden. It is the hidden architecture of the modern world. Every war, every crisis, every boom, and every bust sits on top of this invisible scaffolding of promises. And if you follow the chain of creditors long enough, you discover something unsettling. The world does not owe money to anyone in particular. In a strange, circular twist of fate, the world owes this money to itself. However, that does not mean everyone benefits equally. To understand how we reached this precipice, we must go back to the beginning, centuries before the first credit card swipe or digital transfer. The idea of national debt was born not on Wall Street, but in the desperation of war. In 1694, England was fighting France and rapidly running out of gold. The king turned to merchants for help. In exchange for a permanent stream of interest payments backed by future taxes, these merchants financed the crown. To manage this new arrangement, the Bank of England was created. It was a revolutionary moment in human history. The state could now spend money it did not yet have. In return, lenders received something priceless, a promise from the government, one that could be traded, bought, or sold. That was the birth of the government bond, the seed of the modern financial system. France copied it. The Netherlands refined it. The newly independent United States adopted it to fund its revolution and later its expansion westward. National debt became not a mark of failure, but a measure of credibility. The ability to borrow was the ability to rule. Empires once conquered territory to extract gold. Now they issued bonds to extract interest. The battlefield became the balance sheet. Fast forward 3 centuries, and debt has become the world's dominant export. Global borrowing increases by the equivalent of $1 trillion every 100 days. Every country owes. Every bank lends. Every citizen, through taxes, savings, and pensions, is both a debtor and a creditor. But who holds the other end of the rope? This is where the common narrative often fails. There is a persistent myth that foreign adversaries hold the destiny of Western nations in their hands. People often point to China as the biggest lender to the United States. While it is true that China holds roughly $800 billion in American debt, this represents only about 2% of the total. The reality is far more insular. The United States debt is not just national, it is deeply personal. Out of that $38 trillion, roughly 70% is owned by Americans themselves. The United States Treasury issues bonds. American banks, pension funds, mutual funds, and insurance companies buy them. The Federal Reserve often buys them back, creating new dollars in the process. Americans pay taxes that fund the interest on those bonds, which then flows back into American retirement accounts. It is a circular mirror. The debt is real, but the creditor is mostly a reflection of the same system. And this circularity is not just American, it is global. Japan lends to the United States through treasuries. The United States lends to Europe through the International Monetary Fund. Europe lends to developing nations through the World Bank. Developing nations, in turn, lend back to advanced economies by parking foreign exchange reserves in Western bonds. It is a planetary game of hot potato, except the potato is made of promises. Every country holds someone else's IOU. Every promise is secured by another promise. It is like a poker table where every player has borrowed chips from the next, and the only rule keeping the game alive is that nobody stands up. But there is a fourth layer, the most powerful of all, the markets themselves. Behind every government bond sits a web of institutions, hedge funds, sovereign wealth funds, and central banks, managing tens of trillions of dollars in assets. They are the true arbiters of credit. They decide which nations can borrow cheaply and which will pay a premium for survival. When they lose confidence, currencies collapse, governments fall, and entire economies can be restructured overnight. Democracy decides who governs. Markets decide who survives. The ultimate market maker, the modern high priest of this system, is the central bank. Central banks do not merely manage debt, they manufacture it. Every time the Federal Reserve or the European Central Bank buys government bonds, it creates new money in exchange. The liability of one balance sheet becomes the asset of another. Every dollar in circulation represents a unit of debt somewhere else. There is no such thing as debt-free money in our current system. Every coin, every bill, every digital dollar has an invisible IOU engraved on its surface. For decades, this loop has sustained itself through confidence. As long as investors believe governments will pay interest, even if they never repay the principal, the machine keeps turning. But what happens when confidence wavers? We have seen the preview. In Greece in 2010, the government's debt became unpayable. Bondholders panicked. Yields spiked. The rescue came with austerity, tax hikes, spending cuts, and mass unemployment. For an entire generation, bailout became another word for sacrifice. In Argentina, repeated defaults turned debt into a national curse. In Sri Lanka, fuel shortages and political collapse followed when the government ran out of foreign currency to service loans. When the system breaks, the creditors suddenly become visible. They are the International Monetary Fund, the rating agencies, and the anonymous bondholders who hold entire nations by the throat. And yet, even after collapse, the same logic restarts. New loans replace old ones. Old debts are restructured. The machine resets with a new name on the same balance sheet. That is because, in the 21st century, debt is not designed to be repaid. It is designed to be rolled over. Governments today do not actually plan to pay off their debt. Not now, not ever. That is not a conspiracy theory. It is policy. When an individual takes a loan, they are expected to repay the principal. But governments operate differently. They treat debt like a rolling subscription, issuing new bonds to pay off old ones, a process economists call refinancing. Interest becomes the real product, the rent charged for stability. The global economy now depends on that rent. Like a shark that must keep swimming to breathe, the global financial system today runs on confidence, not repayment. The United States will never clear its $38 trillion debt. It will refinance it forever. Japan has been rolling over its debt for decades, causing it to exceed 250% of its gross domestic product. And yet, its government bond yields remain near zero. Investors are not waiting to be repaid. They are waiting to renew the deal. Why? Because for them, government debt is the safest collateral in existence. A United States Treasury bond is not viewed as a liability by the banking sector. It is viewed as a prime asset, the foundation of global markets. Pension funds hold it. Banks use it as security. Central banks treat it as money. The system depends on governments never paying off their debt, because if they did, the world would lose its most trusted financial instrument. Imagine if Washington somehow decided to pay down every last dollar of its debt. Banks and funds around the world would suddenly lose their most stable asset. The dollar supply would shrink dramatically, triggering deflation and economic collapse. Paying off the debt would destroy the very thing that makes the economy function. So, governments do the opposite. They keep issuing more, not recklessly, but rhythmically. The debt becomes a kind of heartbeat for capitalism itself, pulsing through every pension, mortgage, and market on earth. This is why, when politicians talk about balancing the budget or paying down the national debt, they are selling an illusion. The goal is not to eliminate debt. The goal is to keep it sustainable, serviceable, and desirable enough that the system never stops believing in it. Because once belief fades, the numbers stop mattering. Confidence collapses, interest rates spike, and the economy built entirely on rolling promises grinds to a halt. That is the real secret of sovereign debt. The plan was never to pay it back. The plan is to keep the world believing it will. It is a closed loop of trust, and as long as that trust holds, the numbers can stretch indefinitely. But trust is not evenly distributed. When we say we owe it to ourselves, that is only half true. Interest payments do not flow equally through society. They flow upward from taxpayers and workers to the institutions and investors that hold the debt. In other words, debt is not just a transfer between countries, it is a transfer between classes. That is why global inequality and global indebtedness rise together. The system rewards those who own debt and punishes those who merely pay it. The problem arises when the engine runs out of fuel, when new borrowing cannot keep pace with the promises made before. This brings us to the concept of the bond vigilantes. These are the investors who police the market. We saw their power in the United Kingdom in late 2022. When the government announced a spending plan that the markets deemed reckless, the bond vigilantes revolted. They stopped buying bonds. Prices crashed, and yields skyrocketed. The central bank had to intervene to save the pension system. It was a stark reminder. The government may print the currency, but the market decides its value. We are currently seeing the rise of debt service costs to alarming levels. In the United States, the federal government now spends nearly $1 trillion a year just on interest payments. That is more than the entire military budget. It is almost as much as the country spends on health care. When a government spends 1 out of every 4 tax dollars just to service old debt, it enters a trap. It must borrow more just to pay the interest on what it already owes. This is the mathematical definition of a Ponzi scheme. Yet it is legal because the borrower owns the printing press. This raises the terrifying question: how does it end? There are only 3 ways out of a debt trap of this magnitude, and none of them are pleasant. The first is a hard default. This is when a government simply stops paying. This leads to immediate depression, social unrest, and a loss of access to international markets. For a major economy like the United States, this would effectively end the current global financial order. It is the nuclear option. The second option is austerity. This involves massive spending cuts and tax hikes to generate a surplus. But in a democracy, this is political suicide. No government wins an election by promising to slash pensions, crumble infrastructure, and fire public workers. Austerity shrinks the economy, which makes the debt burden even heavier relative to the size of the gross domestic product. That leaves the third and most likely option: financial repression and inflation. This is the hidden default. Central banks print money to buy the debt, keeping interest rates artificially low. This floods the system with currency, causing prices to rise. Inflation allows the government to pay back its debts in nominal terms, but with money that is worth significantly less than when they borrowed it. It wipes out the real value of the debt, but it also wipes out the real value of your savings. It is a silent tax. The government gets out of debt by eroding the purchasing power of its citizens. We are already seeing signs of this shift. Smart capital is moving. Record sums are flowing into gold, an asset that carries no counterparty risk. Central banks themselves are buying gold at the fastest pace in history. They know that in a world of $315 trillion of paper promises, the only thing that is truly safe is an asset that cannot be printed. Investors are starting to ask the forbidden question: what is a risk-free return worth if the currency itself is losing value? Beyond the immediate financial mechanics, there is a geopolitical earthquake rumbling beneath the surface. For 70 years, the global financial system was held together by the gravity of the United States dollar. It was the sun around which all other currencies orbited, providing a stable, albeit imperfect, reserve asset that facilitated global trade. But as debt levels reach unsustainable limits, that gravity is weakening, and the trust that underpins it is fracturing. Nations that once blindly accumulated Western debt are now looking for exits. This is not just about economics. It is about sovereignty and power. When the United States and its allies weaponized the financial system by freezing sovereign foreign reserves during recent geopolitical conflicts, a chilling message was sent to the rest of the world. Your national savings are safe only as long as you align politically with the issuer. For major global powers and the emerging economies of the global South, this political risk is no longer acceptable. We are witnessing the slow but steady fragmentation of the single global market into competing economic blocs. This process, often called deglobalization, is inherently inflationary. The ruthless efficiency of a single, frictionless global supply chain is being replaced by redundant, resilient, and politically motivated supply chains. This means goods will cost more to produce, capital will flow less freely across borders, and the interest rates required to attract skeptical lenders will remain structurally higher. This shift fundamentally alters the social contract that has defined the Western world since the 1980s. The implicit deal was simple. We would export manufacturing jobs to keep consumer prices low and we would use cheap credit to maintain a high standard of living despite stagnant real wages. That deal is now broken. Cheap goods are vanishing as supply chains fracture, and cheap credit is dead as debt loads become unmanageable. The average citizen is now left squeezing the middle, facing the dual headwinds of rising costs and a financial system that requires inflation to survive. This is the hidden human cost of the debt supercycle. It is not merely about numbers on a government ledger. It is about the slow, grinding erosion of future prosperity. When a society spends today what it has not yet earned, it is stealing from tomorrow. We have been stealing from tomorrow for decades, and tomorrow has finally arrived. The volatility we see in markets, the polarization in politics, and the widening gap between the asset-rich and the wage-poor are all symptoms of a financial system that has reached its mathematical limit. We are entering a period of history where hard assets, tangible production, and fiscal reality will matter more than financial engineering. The modern financial system has turned debt itself into money. Governments issue it, banks multiply it, investors trade it, and citizens depend on it. The line between debtor and creditor has blurred beyond recognition. Debt once meant bondage. Today, it means balance. But if that balance ever tips, if confidence breaks, the illusion ends, and we will remember what debt really is. A promise that cannot be kept forever. The world is addicted to debt because debt has been free for so long. We are coming out of an era of zero interest rates, a historical anomaly that encouraged reckless borrowing. Now, the bill is coming due. The bond market, the ultimate arbiter of truth, is beginning to wake up. The drumbeat of warning is getting louder. Whether it ends in a sudden crash or a long, inflationary slow burn, one thing is certain. The era of easy money is over. The scaffolding is shaking, and when the dust settles, we may find that the wealth we thought we had was nothing more than a reflection in a mirror. A circular promise that everyone believed simply because everyone else did too.